Okay, I guess we'll get going and people will join us as they come along. Welcome everyone. My name is Justin Martel. I'm professor of finance at the ESSEC Business School and co-head of the ESSEC-Amundi Chair on Asset and Risk Management. So on behalf of Maria, Sophia Ramos, and myself, it's a pleasure to welcome you to the first 2022 webinar organized by the chair. I would also like to thank Vanessa Thomas, who's responsible for the logistics of this webinar. So with the pandemic, the ESSEC-Amundi chair decided to launch a series of webinars. Last year, we covered topics such as green finance, ESG investing, ESG news, financial markets, and active asset management. The 2022 series is launched with a topic which appears to be the biggest challenge ever faced by our generation and those coming, climate change. Climate change is now a reality and represents a major challenge and a threat to our societies.
Today, I'm pleased to present our paper, Climate Stress Testing. This is joint work with Rob Engel and Richard Berner at NYU Stern. And the disclaimer applies. The views here are the authors, not the Fed systems or the New York Feds. So understanding the effect of climate change on financial stability is a very important question for researchers, banks, and regulators alike. And how could climate-related shocks impose systemic risk on financial sector? If banks systemically suffer huge losses after a sharp increase in either transition risk or physical risk, then climate change can affect financial stability. Just to be on the same page, by transition risk, I mean the risk that comes from changes in policies as economies move into less carbon-intensive environment. And by physical risk, I mean the risk that comes from damage to property following extreme weather events or longer-term changes in climate patterns. And one of the key questions here is about quantification. How much systemic risk does climate change impose on financial systems? That's the research question of our paper. And of course, there are many approaches to this. And before we jump into the model, let me briefly discuss some of the challenges that we face in climate stress testing and how we tried to address them. So first of all, the analysis based on the climate events may not effectively capture the changes in the perception of risk. This is because, for instance, market expectations can change without a direct experience of climate change events. And also market prices today can reflect the changes in climate risk in the future, even though the damages are decades away. So to this end, we use market-based methodology. So it allows us to fully incorporate the changes in market expectations. And the second challenge is that the climate risk itself changes over time, and how firms, banks, and markets respond to the perceived risk also changes over time. So to address this challenge, we estimate a dynamic model. So we do not assume that the bank's asset holdings or leverage is constant over time, and we allow volatilities and correlations to be time varying. And lastly, our methodology only requires publicly available information, and we can estimate our model on a daily basis. So we think our measure could be a useful and timely monitor. So in this paper, we developed a climate stress testing methodology to test the resilience of financial institutions to climate-related risks. And our methodology is market-based, and it involves 3 steps. The first step is to measure the climate risk factor. And the second step is to estimate time-varying climate beta of banks. So the climate beta will capture the bank's exposure to the climate risk factor that we measured in the first step. And once we have the climate beta for each bank, then we can compute systemic climate risk. And I'm going to call systemic climate risk C risk. And the C risk is the expected capital shortfall of banks in a climate stress scenario. And we apply this methodology to large global banks to understand their climate-related risk exposure. And here are the key findings. First, we find that the climate beta and sea risk went up substantially during 2020. The aggregate sea risk of the top 4 US banks went up by $360 billion during 2020. And this corresponds to about 40% of their market cap. And we decompose this substantial increase into 3 components. And based on a decomposition analysis, we find that the increase in sea risk during 2020 was primarily due to decrease in equity values of banks, as opposed to that deterioration or increase in risk itself. Because the second finding could mean that banks were already under stress in 2020 without any climate stress, so we looked into marginal sea risk. So the marginal sea risk is the difference between the sea risk and non-stress sea risk, where the non-stress sea risk is simply capital shortfall of banks without any climate stress. And we find that the aggregate marginal sea risk of the top 4 US bank was about $245 billion. So this suggests that the effect of climate stress was substantial. And lastly, we find that the banks with higher exposure to gas and oil loans have higher climate beta and sea risk, which corroborates the economic validity of our measure. Now, let me explain each step in more detail. So the first step is to come up with a climate risk factor. And there can be many ways to do this, but we chose a market-based one. We use Lederman's stranded asset portfolio as a measure of transition risk. So this portfolio is composed of 30% long position in energy ETF and 70% long position in coal ETF. And it's normalized by S&P 500 index. What you see here is the cumulative performance of the stranded asset portfolio return. And you can see that it has been falling since 2011, almost one way. And we interpret this underperformance of stranded asset as a rise in transition risk. And for the time period when coal ETF is not available, we are currently using the average return on the top 4 coal companies. And once we have this climate risk factor, we can estimate each bank's climate beta. So the climate beta is the bank's stock return sensitivity to the climate factor we just estimated in the previous step. And we model the bank stock return with 2 factors. So the first factor is market factor, and the second factor is the climate factor. And the loading on the second factor is what we're calling climate beta. And we estimate this model dynamically, so we allow for volatilities and correlations to be time varying, and we estimate this on a daily basis. And in general, we expect to see positive climate betas for large banks because they have large exposure to gas and oil loans. And here are the climate beta time series for the top 10 US banks. So first of all, you can see that the climate betas move around, which suggests that it's important to estimate this dynamically, especially given the time varying nature of climate change. And if we look at the time series, the climate beta started from 0, and then they fell into slightly negative territory here in the beginning of the financial crisis. And they are rising, and there was a substantial increase in climate betas across banks in 2020, and the peak when the energy prices collapsed. And the peak was in November 2020. And the reason why we are seeing the negative climate beta here is because in the beginning of the financial crisis, the energy prices were still on the rise, but everything else was pretty much falling. So for this time period, we are seeing negative beta. And we also looked into some of the climate change related events. And the climate betas do not respond to every single climate change related events. But we can see that, for instance, after Trump administration withdrawing from Paris Agreement, we see that climate betas are falling a little bit. And around the Biden election, the climate betas were rising. And here are the climate betas for the UK banks. And the climate betas were on average slightly higher in the UK than in the US. But we can see that there's a common pattern that the climate betas were rising in 2020. And we looked into other countries as well. And for instance, France, you can see that there was also a substantial increase in climate betas in 2020. Once we have the climate beta estimates, then we can estimate the sea risk. And here we follow the S-risk methodology. So the sea risk is defined as the expected capital shortfall conditional on climate stress. And it's a function of book value of debt D and W, the market cap of the bank, and long run marginal expected shortfall, which is the expected equity loss conditional on climate stress. And this long run marginal expected shortfall term will have the beta that we estimated in the previous step. And it also depends on theta. The C risk is also a function of K, which is prudential level of equity relative to assets. And we set it as 8% and 5.5% for European banks to account for accounting differences. And the theta that mentioned earlier is the climate stress level. And we calibrate the stress level data to be 50% because negative 50% is the 1% quantile of 6-month return on the stranded asset portfolio. So the climate stress scenario that we're considering here is 50% down in the stranded asset portfolio return over a 6-month time period. Okay. And here are the C risks of the top 10 US banks. And because the C risk is not a sole function of the climate beta, so a bank with high climate beta in earlier plot may have low C risk if the bank is sufficiently capitalized. And positive numbers here mean that there was an expected capital shortfall, and negative numbers can be interpreted as excess reserves. And in any case, I would like to highlight that there was a sharp increase in C risks across the banks during 2020. And of course, during the financial crisis, the banks are vulnerable to market risks as well as the climate risk. So that's why we are seeing peaks here. But later, in a later slide, I can show you an important difference between the previous 2 peaks and the recent peak. And here are the C risks of the UK banks. The increase is not as dramatic as in the US banks for 2020, but in many countries, for instance, in France, we can see that there was a substantial rise in C risk during 2020. So what happened in 2020? So we looked into the year, we zoomed into year 2020, and on the left-hand side, what you're seeing is the C risk of the top 10 US banks. And you can see that it was at the end of the first quarter that the C risk jumped. So for instance, the green one is Citibank, and its C risk jumped up from $20 billion to almost $100 billion. And on the right-hand side, what I'm showing is the table of loan exposure to gas and oil industry for these top 10 US banks. And although the rankings do not correspond perfectly, The top 4 banks in terms of sea risk were the Citigroup, Wells Fargo, Bank of America, and JP Morgan. And you can see that those are the top 4 on the right-hand side table. And the UK banks, we see the similar result. So the top 2 banks in terms of sea risk were HSBC and Barclays. And again, those were the top 2 banks on the right-hand side. They were having high loan exposure to gas and oil industry. And next, we decompose the change in sea risk into 3 components. So the first component is the contribution of debt to the changes in sea risk. And the second component is the equity deterioration's contribution to the change in sea risk. And the last component is coming from change in the risk. And this is the decomposition result for the US banks. And the first column is the sea risk at the end of 2019. And the second column is the sea risk at the end of 2020. And the third column is the change during 2020. And the next 3 columns are the decomposition. And when I add up these 4 numbers, the changes in sea risk during 2020, then they add up to $364 billion. And about 75% of it is coming from equity deterioration. And similar result for the UK banks. You can see that the aggregate change in sea risk of these 5 banks in the UK were about $134 billion. And more than 75% of it is coming from equity deterioration. So looking at these results, we thought maybe banks were already under stress in 2020 without any climate stress. So we looked into the marginal sea risk. So the marginal sea risk is the difference between the sea risk and the non-stress sea risk, where the non-stress sea risk is simply the equity shortfall of banks without any climate stress. And what I'm showing you here is the marginal sea risk for the top 10 US banks. And you can see that they were not so high until 2019. And the gap opened up in 2019 and they remain high. If I add up the marginal sea risk of the top 4 US banks, then they add up to about $245 billion. And you can see that during the financial crisis, the previous financial crisis, we don't see the peaks here. So this is the difference, the important difference that I was mentioning earlier. And here is the marginal sea risk for the UK banks. In the UK, we are not seeing a sharp increase in the marginal sea risk in the recent time. But in some countries, for instance, in France, we can see that some banks' marginal sea risks are on the rise. And we also compared the marginal sea risk with the marginal S risk measure. So the marginal S risk in red is capturing the effect of the market stress, and the marginal sea risk in navy line is capturing the effect of climate stress. And in terms of the magnitude, the marginal sea risk is about half of the marginal S risk. And you can see that the proportion is rising across banks. And these are for the UK banks. In the UK, the bank's marginal S risks and C risks are not as high as in the US, but you can see that the marginal C risk is becoming a non-negligible part of the marginal S risk. And lastly, we also compare the climate beta of banks with the bank's gas and oil loan exposure. And what you see here is a positive relationship between the climate beta and the bank's active gas and oil loans in logs at the end of the first quarter of 2020. you can see that banks with higher exposure to gas and oil loans have higher climate beta. And we also tested this with a regression analysis, and we find that the relationship is positive across specifications. So that corroborates the economic validity of our measure. And to summarize, in this paper, we developed a climate stress testing methodology to test the resilience of financial institutions. And we introduced a measure called Sea Risk. And we are hoping that this could be a complement to other stress testing methodologies, as well as scenario analysis. And these are what we are currently working on. So first of all, we are constructing confidence interval so that we can have the interval for the climate beta estimates. We are using bootstrapping approach here. And we are also working on improving the factor model. We are currently having the two-factor model, but we include common risk factors in bank stock returns, and after adding some risk factors such as interest rate related factors, we still find the common pattern. And we are also working with alternative measures of climate factor. So for instance, we use, instead of the stranded asset portfolio return, we also used emissions-based return measure and also some industry-based measures. And again, with these alternative measures of climate factor, our results are pretty robust. And we are also working on verifying and improving exposure measures by using granular data on bank holdings. And we're going to expand the sample of banks. And we hope to extend this research to other financial sectors, such as insurance sector or money managers. And lastly, we are currently focusing only on the transition risk. And to have a full picture, we hope to include physical risk. And this concludes my presentation. And I would be happy to answer any questions. Thank you.
Thank you very much, Hyeyoon. Any question from the audience? I see nothing on the chat, but if anyone has a question. Here's a question by someone. In your approach, climate risk is restricted to stranded asset. Are you considering possible extensions to physical risk or other types of transition risk?
Thank you for the question. So as I mentioned briefly, currently we are focusing only on the transition risk, but we tested alternative measures of stranded asset portfolio. So for instance, we constructed a global coal portfolio, and also we constructed a measure by selecting, taking the average return of the firms from industry with the highest emissions, and we still find a similar result. And we can definitely test for more, test with more factors. And the physical risk, we have a use-based measure, but one of the limitations is that it's hard to, they are not signed. So, and it's more about an attention measure. So once we have a nice climate physical risk factor, then we can include this into the framework, but we don't have we are working on it. Thank you.
Another question. Thank you for this very enlightening presentation. I want to know if the use of book value for debt is for approximating its market value in the sea risk equation. Right.
So the sea risk equation, we are using book value of debt. So what we are measuring here is like a quasi market value of the assets of the bank. And this is partly coming from the S-risk methodology. So S-risk methodology is for measuring systemic risk, and they are using the book value of debt and market cap of the bank and it's partly because it's not easy to measure the market value of debt on a frequent time basis. So that's the reason. Thanks for your.
Another question: is climate stress test a good practice, or is it part of the regulatory requirements?
I don't have an answer to that question. I think it's worth monitoring with this methodology, but our methodology is really relying on the market expectation, and we currently have the physical risk part, and I don't think there is a perfect methodology to assess the climate risk of the financial institutions. So my thought is that there should be multiple ways to monitor this risk.
In fact, an extension to this question was, does it affect Basel II and Basel III capital reserve calculations?
That's another question, and I don't have an answer, but it's a great question.
Yeah. It's not, I guess what you mean is it's not being put in practice by regulator now. This is just a measure of the impact of this climate risk, but we don't know exactly what the regulatory authorities are going to do with this.
Exactly. Thank you for putting it in a nice way. Thanks.
That's always a difficulty from going from theory to practice. How do you implement these things? And that's a more difficult question.
So implementing this methodology is not too complicated because first we only rely on the publicly available information. So all we need are the book value of debt, market cap, and the return on the banks on a daily basis, and also the stranded asset portfolio return. So implementing this is relatively easy. But to explain the variations, the time series and cross-sectional variation in our measures, then we think it's worth looking into the granular data on the bank's asset holdings.
Another question I had is, there seems to be a big difference between US banks, for example, and other countries. Is that due to their exposition to oil and gas? Is it mainly the reason, or?
So we currently have granular data on the US banks only, so we couldn't do cross-country comparisons. But we were also thinking that it's interesting to see that in the UK, the climate betas were slightly higher on average, but the sea risks were lower in the UK. It's definitely an interesting question.
Another question, what is the basis of setting climate stress test level theta to 0.5? What are the exceptions?
Right, so here the reason why we are calibrating it to 50% is because our climate factor is the stranded asset portfolio return, and the negative 50% is the 1% quantile of 6-month return distribution. So we are considering an extreme scenario.
Okay.
Thank you.
Other questions from the audience?
Yes, maybe can I ask you a follow-up question? So thanks for a great presentation. That was very insightful. What are the current discussions at the Federal Reserve about the evolution of climate stress tests? So could you maybe report a little bit about these discussions and what could be the next steps?
I think we are monitoring on you know that we are working on the climate scenario analysis, and as a research economist, all I can say is that they are considering many methodologies, but I do not know which and when and what methodologies will be selected and how the regulations will evolve. That's a little bit out of my scope.
Thank you.
Thank you.
Any other question?
Can I have a question, please?
Yep.
Okay, thank you for a fascinating talk. And so from the earlier charts, I can see the sea risks results vary from in different countries. So I wonder what the data you used from global data or just based on the country. For example, JP Morgan is a global company. So what the data used for JP Morgan just come from the US or it come from all the countries?
Okay, thank you for asking that. So this is, we are using stock return. So it's a return on the bank holding company. So of course, JP Morgan has branches in many countries, but we are using JP Morgan stock return that's traded on the US exchange. Okay. And in relation to your question, we also considered using local market indices instead of the S&P 500 index, and the stranded asset portfolio could be different for each country. So we are also working on the local market measures.
Okay, thank you very much.
Thank you.
Thank you very much. Other questions? Okay, well, thank you very much, Hyeyoon, for the very, very interesting presentation. And now we'll move on to Spyros Alogoskoufis, who will present the ECB stress test model.
Thank you.
Thank you very much.
Hello, and thank you for the very interesting presentation and for inviting me. Let me just share my screen and let me know if you can see it. Is it visible to everyone?
Yeah. Very good.
Great. Thank you. Thank you very much for the invite. I just will, in this presentation, we'll share a few insights on the methodology results of a project I've been working on at the ECB for more than a year and a half on designing the first economy-wide climate stress test. Before I get into the details, I'd like to say that at this period, I'm taking a temporary leave of absence from the ECB. So any views expressed in this presentation are solely my own and by no means represent the ECB itself as an institution. Now, essentially, what we managed to do with this climate stress test is reprice climate risk for in corporate balance sheets and bank balance sheets for several years into the future. We think that we've brought in a significant innovation in this field, and in particular, we've done this along three directions. First of all, we've managed to design climate scenarios which are able to account for the interplay between transition and physical risk over a very long horizons over the next 80 years. So essentially, this is one of the first stress tests that combines both transition and physical risk and understanding the dynamics behind them. That meaning how mutually exclusive that they are between them. If transition risk increases, how much does physical risk decrease, and vice versa. At the same time, the second very important innovation that we brought was the fact that we managed to introduce very granular climate and financial information, bridging some very important data gaps that exist in the field. So most practitioners who try to capture these risks and quantify them have a hard time doing so because they can't find the right data. What we've managed to do is collaborate with some very niche data providers and bridge some important data gaps, helping us to quantify some of these risks. We've done this for millions of corporates, so about 4 million corporates in the Euro area and about 1,600 banks in Europe. The last very innovative piece that we've managed to introduce was essentially to design new financial models that are able to capture climate risk on firms' financials and credit risk and market risk for banks. So essentially, very early on, realized that the credit risk models that we had at our disposal were not suited for the task, and we essentially designed the new models that could translate climate risk into financial risk jargon. Now, just to give you a preview of the results of this stress test, what we find very early on and across the board is that it's always more costly to not do anything than doing a transition. That means the short-term costs of the green transition are always more than compensated by long-term benefits. That is, when we talk about costs, in this case, we talk about cost to financial stability, meaning the risk to the overall system and the banking system in particular. What we find is that the short-term costs of the green transition are compensated by the investment and rolling out of new green technologies, and act as and are then further compensated by the long-term benefits that these technologies bring. One very alarming fact is that if policies from a green transition are not introduced, physical risks become increasingly riskier over time. And the alarming fact is that they increase non-linearly over time. So the more we delay climate action, the more the risk will hit us, and it increases in an exponential manner. And the problem is that due to the irreversible nature of climate change, we will reach a point in time where it will be very difficult to return to previous climate patterns. Now, what our models show is that impact from climate risks on average are increased moderately. However, they are concentrated in areas and sectors. So there is a significant degree of concentration here. For corporates and banks most at risk, the impact can potentially be very severe, with possible consequences for financial stability. Now, starting with the scenarios, we worked from the NGFS scenarios that I guess a lot of you might be familiar with, and we used the first phase of NGFS scenarios published in the summer of 2020. These scenarios, of course, are now the industry standard, but their first phase had a few challenges to work with that we needed to improve on. Now, first of all, transition and physical risk impacts on GDP were modeled separately, meaning there was an endogenous model that modeled transition risk, and then physical risk was exogenously modeled by another model. So we were using very granular data, we were able to put them together and disaggregate them from the 11 macro regions to a very granular data set that managed to capture transition and physical risk impacts at the firm level for millions of firms worldwide. Now, going forward, just to give you a description of what these scenarios are. Now, we're working with 3 states of the world. And in these 3 states of the world, we are looking at different levels of transition risk and physical risk. So essentially, you can look at this chart on the left, where on the x-axis we have physical risk, on the y-axis we have transition risk. And the 3 scenarios that we're working with have different levels of each risk. Now, you're all familiar with transition risk, which is essentially the risk of an abrupt transition to the green economy, and physical risk, meaning the increase in frequency and magnitude of natural catastrophes in case climate change is not mitigated. Now, our first scenario, and what we call in stress testing jargon our reference scenario, is essentially an orderly transition where we assume that the world moves slowly and gradually towards a net zero in 2050 Paris alignment target. And this happens through early and effectively implemented policies, where regulators implement those policies early and they communicate them quite clearly from the beginning. Given this smooth and gradual transition, there are limited costs from the transition. And the fact that we managed to become, as a world, net zero by 2050, it leads to also limited costs from transition, from physical risk. Now, on the other hand of the spectrum, we're working with a hothouse world. In this hothouse world, no new policies are implemented. We assume that the current policy mix is in play. And even then, governments fail to meet their already announced reduction targets. That, of course, means that transition never happens. We never move towards a greener economy. So there are very limited costs from the transition. However, climate change is left unmitigated and physical risk costs become extremely high. In the middle of the two, we're working with a disorderly transition scenario, where essentially we assume that the world delays in implementing climate policies. And because they want to still achieve the Paris alignment targets, whenever they implement those policies, they have to do it more aggressively to compensate for the lost time. Meaning that the policies are now stricter, tougher, and there are high costs from the transition and other costs from physical risk. However, in this world, we assume that policymakers are successful in mitigating climate risk and climate change, and hence we don't run the risk of extreme physical risk. Now, just to give you an idea how the numbers look like and translate for those scenarios. The chart on the left essentially plots the GDP evolution from 2020 to 2100 as given by the NGFS scenario calibration. The focus of our climate risk stress test is on the first 30 years, that is 2020 to 2050, where we assume that by 2050 the world would be net zero for the two transition scenarios. As you can see, these NGFS scenarios are not Armageddon scenarios. They don't assume that climate change will bring the end of the world and a collapse of the world economy. GDP is always increasing, and it does so in a steady rate, and GDP growth is always positive. However, there are important deviations from the orderly transition scenario, and these are only due to climate change factors, meaning that in this setup of the NGFS, there are no big macrofinancial shocks that enter the picture. The economy grows in its steady state path, and whatever deviations we have from the steady state path is due to climate risk factors. Now, zooming on the differences across scenarios on the chart on the right, what we see is that at the beginning, basically this chart plots GDP deviation from the orderly transition. So the orange bar is the disorderly transition, and the red bar is the hot household difference from the orderly transition scenario on GDP. Now, in the beginning, given that in the orderly transition in the first 5 years, there are climate policies being introduced, transition risk is high, GDP is higher in the transition, in the disorderly transition and hot household scenarios. However, as the cost of the transition in the orderly scenario are compensated by long-term benefits, this trend reverses. And as you can see, by 2050, the orderly transition scenario has the highest GDP. This is then followed by the disorderly transition scenario, and at the end, the hothouse world. The hothouse world is an odd case because the extreme costs from physical risk materialize over very long horizons, while the costs from the transition materialize over short-term horizons. If you see by the end of the century, in a scenario where no climate action is taken, GDP is going to be 10% less than in an orderly transition scenario. So obviously, in a nutshell, the orderly transition is the first best option, while the hothouse world is the worst, particularly in the long run. And the disorderly transition still has advantages, even if limited, with respect to policy in action. Overall, and this is a theme that you will see throughout the presentation, the costs of the transition are more than compensated from reduced damages from physical risk in the medium to long run. Now, moving to the second innovative feature of our project, essentially what we've managed to do is design a very granular counterparty level exercise. Now, we've managed to collect very granular climate and financial information for millions of corporates and thousands of banks. Now, this data infrastructure is split into three, let's say, dimensions. The first one is climate risk data, physical risk, and transition risk data, where we collaborated with two niche data providers. For physical risk, we worked with a company called 427, where they provided us with address level scores on the probability and intensity of 6 different natural hazards for 4.3 million firms worldwide. So imagine that for any firm in our sample, given that we have the address, we are able, for floods, for example, to have a forward-looking indicator on the probability of that address being flooded and how many meters of water we should expect at that address. For transition risk, we worked with another company called Urgentem, where they supplied us with both backward-looking and forward-looking information on Scope 1, Scope 2, and Scope 3 emissions. So for the 5 million firms worldwide, we have a 10-year time series on their emissions, and then we have a 30-year projection on how these emissions are going to play out, which is a function of NGFS scenario emission pathways, obviously, sector level characteristics, and firm level disclosure targets on the emission reduction path. The second bucket is financial information, where we managed to obtain historical information for all these millions of firms in our sample using a variety of commercial data providers, Orbis, Icon, Bloomberg, and IBAH. The last bucket is essentially bringing the first two into regulatory data sets, which show the exposures of banks to these corporates. The first one is on accredit, where an accredit is a data set that gives us loan by loan information for corporate credit exposures of all banks in the euro area. And then SHS, which is security holding statistics, which is essentially all the financial securities held by banks in the euro area. And our final sample, when putting all these buckets together, is about 2.3 million European firms, which is around 80% of the entire unaccredited, that is almost all euro area bank corporate credit exposures, and a very large sample of banks, which is about 1,600 consolidated banking groups. Now, just to give you an idea of what our climate data look like. The chart on the left basically plots a heat map of country sector emissions in the euro area. Essentially, what we see is that for transition risk, that is the level of emissions, the country dimension doesn't matter. What matters is the sector of activity. And what we see is that the most polluting sectors, the most polluting companies are in the mining, electricity, and manufacturing sector across countries. The difference is small. Well, on the chart on the right, what you see is physical risk. And there, geographical dimension really matters. This map plots all the firms in our sample, meaning that every dot that you see in the map is a firm in its location. And the color of the dot basically shows the most prevalent natural hazard at that location, meaning that if you see a red dot, it means that for that firm at that location, the most relevant risk is wildfires. So this map doesn't really show levels of risk, but rather sources of risk. And what we see is that there's a significant heterogeneity of physical risk hazards across country. In the Central and North Europe, floods seem to be more relevant, while in the south of Europe, wildfires and heat stress are more important. Putting this data together with the bank and regulatory data sets, what we see is that banks' exposure to transition risk and physical risk basically follows the sectoral and geographical dimension split that I mentioned in the previous slide. Now, banks' exposure to transition risk, here measured as % of loans given to high, medium, and low emitters, is quite homogeneous across countries. Now, the euro area average bank has given, in its corporate loan book, has about a 40% exposure to high emitters. And you can see that almost every country, almost every banking system is around that average. The exception being heavy industrialized countries such as France or Italy. But for everyone else, the distribution is more or less the same. However, that changes massively in physical risk. If we look at the percentage of loans in the bank's portfolios that are exposed to high physical risk, where here we define high physical risk as those firms that have more than 1% probability of being hit by either a flood, a wildfire, or a sea level rise, we see that in the euro area, the average is about 22%. However, when we focus on the countries in the south, such as Greece, Cyprus, Portugal, or Spain, that number increases massively. For Greece, for example, almost all of the exposures are given to firms that have a high physical risk. In Spain, that number is about 65%. And what we see is that these results are quite alarming, because it seems that entire countries and entire banking systems are affected by a very high degree of physical risk. Now, climate change is a story of the extremes. Essentially, what we see is that climate change amplifies already existing vulnerabilities. And here we try to plot the tail risk in the bank sample. Now, for transition risk, we see that approximately 150 banks, that is 10% of our sample, account for 60% of overall emissions in the euro area. So essentially, a small proportion of banks finances the majority of overall emissions, which of course raises some concentration concerns. On the other hand, as we saw earlier, only 22% of total banks' exposures is subject to high physical risk, with the concentration being in the south of Europe. And the most prevalent natural hazard seems to be wildfire. And the reason that the wildfires are so prevalent here is we find that they can affect a very large geographical areas. And at the same time, during the summer, there can be more frequent than a flood, for example. Now, the last very innovative feature is our novel models. Essentially, this climate stress test exercise is an exercise in predicting climate-adjusted probability of default. So the big output of our project is to estimate how probabilities of default in credit portfolios will be affected by climate risk factors. So essentially what we do is we reconstruct a simple model of predicting probability of default, where we assume that it follows a standard Altman Z-score, where probabilities of default are a function of corporate profitability, corporate leverage, and some macro variables. Now, in order to get to the probability of default, we stress corporate profitability and corporate leverage on a variety of risk drivers for transition risk and physical risk at the same time. So thanks to our very granular data, we are able to capture a very large number of risk drivers, which we think is the first climate stress test to achieve that. And for transition risk, for example, we look at carbon costs, change the cost of technological change and energy efficiency and the demand for goods. And just to give you a simple example, if, for example, we assume that during the transition carbon price increase, we are able to estimate how much more carbon taxes a firm will have to pay based on its direct emissions. Then we look at how the transition will affect the energy prices and energy consumption of firms. And looking at very granular data on these two dimensions, we are able to project forward how much will energy costs increase for firms. At the same time, we are able to, using Scope 3 emissions, we're able to capture a change in consumer preferences. So how much will sales of carbon-intensive goods change over the years as a result of the transition? So essentially, for transition risk, we're capturing both demand-side and supply-side dynamics, projecting both revenues and operating expenses of firms as a result of the transition. Putting the two together gives us, of course, corporate profitability. On physical risk, we're working with two risk drivers, mitigants and amplifiers. What we've done, thanks to the very granular data from 4 to 7, we've able to estimate the expected damages to physical capital thanks to natural hazard. Essentially, for every year in our sample, we are able to attribute expected losses of physical capital for each firm based on natural catastrophes. We then feed that loss of capital into the production function, and essentially we're able to estimate how much will revenues drop because now firms have less physical capital to deploy in producing previous level of outputs. At the same time, we consider mitigants, such as insurance coverage, which protects physical capital from damages, and amplifiers, meaning how much will insurance premia increase in those vulnerable areas and how much will that affect corporate profitability. On corporate leverage, we focus a lot on the impact of technology, and we've been able to compute a green price, meaning how much will it cost to remove 1 ton of carbon emissions from a firm's production process. And we assume that firms need to raise debt to finance this technological change, and that affects the probability of default. And once the probability of default is computed, we go in and we reprice both corporate loans from unaccredited, as well as losses from corporate bond repricing. So using corporate bonds, using probability of default, we're able to reprice corporate bonds. Now, going into the results. One very obvious result, as mentioned earlier, is that the short-term cost of the transition are always more than compensated by long-term benefits. Now, these 3 charts plot different firms, different buckets of firms in our sample, those that are low risk, meaning very low transition and very low physical risk, those that are highly carbon intensive, so high transition risk, and those very high physical risk firms. And each chart plots the probability of default projection path as a difference from the orderly transition scenario. Looking at the chart on the left, what we see at the beginning is that there are short-term costs associated with the orderly transition, i.e., probability of default in the orderly transition scenario is lower than the other 2. However, as time passes by and those costs of the transition are more than compensated by the long-term benefits, we see that the probability of default in the 2 adverse scenarios increases. And by the end of the horizon, by 2050, both disorderly transition and hothouse world show a higher probability of default for these firms. Those long-term benefits of the transition are not only concentrated in the orderly transition scenario, because what we see, and this is a very interesting result, is that the hothouse world is always higher than the disorderly transition in terms of PDs across all firms. Now, looking at the chart in the middle, for those carbon-intensive firms, obviously, the cost of the transition are amplified because these firms have a higher number of emissions to remove from their production process, and the benefits are minimized. However, at the end of the horizon, the hothouse world is still makes them worse off. On the chart on the right, we plot the PDs of high physical risk firms, where we observe massive long-term benefits of an orderly transition. Now, those firms most exposed to physical risk show a massive increase in PDs because as time goes by in the hothouse world scenario and those physical risks increase, the PDs increase with them. So this basically, the path that we observe here on the red line is basically cut off by the horizon. If we were to extend this by another 50 years, the slope would still be the same. PDs would still keep on increasing, particularly as physical risks keep piling up. Translating those corporate level results to banks, we are projecting the PDs of the corporate credit portfolios. So the chart on the left essentially plots the PDs of the median bank portfolio for corporate credit exposures only. Again, this chart shows the difference of the orderly transition scenario versus the two adverse scenarios. And what we see is, again, a similar story. There are short-term costs associated with the transition. However, physical risk always makes banks worse off, and the probability of default of these loan books is always higher in the scenario where no climate action is taken. If we look at the average portfolio PD per country, we are more closely able to identify the non-linearities, meaning that there are certain countries that deviate extremely from the euro area average, and those countries more exposed to physical risk seem to have a much higher portfolio PD in 2050. Focusing again on the tail risk. As I said earlier, climate change is a story of the extremes, amplifying already existing vulnerabilities. Now, so if we are to take those top 10% of banks that have the highest credit portfolio PDs, what we see is that the probability of default in the hothouse world of the tail banks compared to the average bank increases by more than 5 times. So essentially, this chart now plots the time series, the evolution from 2020 to 2050 of bank portfolio PDs. The dotted lines is the average bank. The solid line is the tail bank. And what we see, if we compare the red solid line with the red dotted line, is that this increase in PDs at the end is more than 5 times. However, the very encouraging fact is that in the orderly transition, so looking at the average bank, meaning the green dotted line, we see that the orderly transition actually makes firms better off. So the probability of default for those loan books is actually lower than where we started. Now, obviously, 10% of banks sounds like a small number. However, these 10% of banks are quite large, and they account for more or less 20% of the exposures of the entire banking system in Europe. Two other things that we did was to compute climate-adjusted LGDs and climate-adjusted expected losses. So essentially, to compute climate-adjusted LGDs, what we did is we assumed that climate risk impact LGDs via 2 channels. First one, the macro channel, which captures the sensitivity of LGDs to macroeconomic conditions, meaning that we are able to capture how much does LGD move by, let's say, an increase or decrease in GDP. That both includes physical risk and transition risk. And then we have a micro channel, which is essentially the impact on LGD by the depreciation of physical collateral. So if a loan is collateralized by physical real estate, for example, how much will the loss given default change in the presence of physical risk eroding this collateral value? And again, what we see is that physical risk dominates, and LGDs under the hothouse world scenario follow a very similar path as with PDs, and LGDs are higher under the hothouse world scenario. Putting PDs and LGDs together, we're able to compute expected losses for the corporate credit portfolio. And what we see again is that the hothouse world makes banks worse off. The euro area average in a hothouse world scenario shows that we're going to have about 10% higher expected losses than the orderly transition scenario. And if we look at the chart on the right, we see that those countries already exposed to high physical risk, the Southern European countries, will have a much higher impact on their expected losses than their peers. And again, this points to the non-linearities of physical risk impacts. Just to wrap up, the results confirm the benefits of acting early to address climate risks from climate change, and that the absence or delay of climate action can imply significant risk to European financial stability. Now, obviously, this exercise is the first of its kind. It's a massive data and modeling work. And we understand that important gaps remain. We need to improve on data, so that it has to be systematic improvements in disclosures, for example. And of course, we're constantly working on improving our modeling framework. In terms of next steps, the team is planning an update of the methodology, data, and results with the new NGFS scenarios that were published last summer. And by end of this year, we plan to extend this methodology to the dynamic framework, where we are able to capture banks' response to climate risk, allowing them to invest in green loans, for example, and divest from brown ones. This will also help us capture second-round effects of the economy. That is, how will, if climate change affects credit supply, how does that affect macroeconomic conditions? Now, the results and methodology of the paper that I just presented will be used to inform the 2022 supervisory climate stress test. I believe that our colleagues at ECB Banking Supervision have already announced the launch of the climate stress test of this year, which is a bottom-up one compared to the top-down that I just presented. And following up from the strategy review, the ECB will leverage on this exact methodology to conduct a climate stress test in its internal balance sheet and for the entire Eurosystem collateral framework. And with that, I open the floor to questions.
Thank you very much, Spyros. Very, very interesting presentation. Impressive work with the data. Very interesting results, actually. I'm not sure if I should be scared, actually, by all of this, but let's hope that it's going to stimulate discussion. A first question from the audience is that, did you have a way to assess the physical risk to supply chains on top of the physical risk to firms' physical location by address, for example?
No, unfortunately not. And this is actually one of the biggest data gaps that everyone in the industry is facing. It's very difficult to find data on locations of supply chains, and the only geospatial data that we could find is headquarters. So everybody is looking for the locations of all physical assets of firms, but that's something very, very difficult. So what we ended up doing is that for private companies from an accredited, obviously we only know the headquarter address, but for public companies, we went into Bloomberg and Icon, looked at their corporate group structure, obtained the addresses of the subsidiaries, and we were able to get a more or a better, more comprehensive view of their multinational exposures, and thus get a more accurate physical risk score. But of course, that does not come through the entire supply chain.
Yeah. Another question: do you disentangle countries or scale them by taking into account their climate risk-related vulnerability, depending on countries' development level and available energy sources? Some countries are more vulnerable by climate-related constraints and related existing forthcoming regulation. Countries should be treated equally or fairly after controlling for some specific discrepancies.
Mm-hmm. Yes, we did. So essentially, what happens here is that.
What do you wish to wear?
I'm sorry?
No, that's fine. Go ahead.
So essentially, what we did here is we took the macro, the aggregate numbers on GDP from the NGFS, which were on a macro regional level. So imagine the whole of Europe, and we disentangled this to the country level by taking into account the transition and physical risk exposure. For example, we look at the emissions and energy and energy mix to this, and also the physical risk scores to disentangle the GDP impacts from the macro level to the country level. So essentially, yes, we do take that. However, the way that the GDP is calculated by the NGFS providers is on the regional level. So in a sense, this was more of a disaggregation rather than modeling directly country level impacts.
Okay, thank you. I have one question. So you show, and I trust, I mean, common sense would tell us that this is true, that the benefit, the long-term benefits are greater than the front-up costs actually to fight climate change. Isn't the problem, I mean, this is true in aggregate, I can understand. Is this true on a firm level basis? I mean, the question is, I mean, if this was true, then you think that this would come up naturally that we would, invest massively, and the society would be better off. The problem is that these investments have to be made by companies, for example. And I mean, a lot of companies may not be convinced by this because they would do the upfront cost to reduce maybe, climate warming. But what's the benefit for them, actually? They don't perceive it this way. So there seems to be a sort of a paradox between the aggregate welfare value of all of this and the individual, how individuals see it.
Yeah. So I think the answer here is also relates to one of the questions I saw in the chat earlier, is that we need climate stress testing, we need scenario analysis, because this is what points to, this is what raises awareness, in a sense. The problem with physical risk is that it manifests over very long horizons. It's very difficult to see the impact today. Yeah. We're going to see it in 20 years from now. And on top, what climate scientists tell us is that there's a lot of inertia in the system. That whatever we do today with emissions, even if we were to decrease emissions to zero today, we wouldn't see a change in climate patterns until the next 20 years. Yeah. So in a sense, yes, there is a sort of tragedy of the horizon here. However, and this is why it's important that we run these exercises, we run these stress tests, we run these scenario analysis to be able to point and raise awareness that if you don't do this now, there might be no way to solve this 20 years from now. Because you saw the charts. Once we enter that 2040, 2050 region, and we haven't done anything about climate change, there won't be a way to turn back. Like PDs, for example, will just keep on increasing and firms will be better off. So there is a need to invest now. And this is one of the key results of this exercise, that if we don't do this now, we are going to have a very big problem in the future. So obviously I'm aware of all the discussions around discounting factors, and, it will cost us a lot today for minimum benefits in the future if we take the present value. But I think that's not true.
Another question. Impressive work indeed. Have you compared ECB's result for French banks to ACPR results for transition risk?
Indeed, we have. Actually, these are very different exercises. So just to mention that this was a top-down exercise. Everything that was done in this presentation was developed entirely by ECB staff. We didn't take any input from banks. No data, no models, no nothing. So in that sense, the ACPR exercise was bottom-up. So this was all data from banks. And the models were different that the ACPR colleagues used. So it's not very easy to compare. However, the results for both transition and physical risk are quite aligned. We have had conversations with ACPR and Banque de France colleagues, and we are on the same page.
Okay. Other questions from the audience?
Yes, maybe if I can, Jocelyn. So thanks, Spyros, for a great presentation. I'm impressed by the work you did. I was willing to ask you about the balance sheet of the banks that you're considering as static, right? They're estimated in the first place. Do you consider looking at extension of that work, looking at dynamic balance sheets where banks adjust their exposure? And I have another question about the sector dependencies in your model. I was not completely clear about that. So how are they accounted for? Are there, so I guess there are substitution effects, which are coming from, for example, higher carbon prices. So consumer might switch demand from one sector to another. How do you account for that in the model? Can you clarify that?
Definitely. So I'll start with the second question. What we did is we looked at scope 3 emissions of firms. And in particular, we focused on one specific category, which is the use of emissions by consumption. So imagine a company selling diesel cars, and you as a driver, for the next 10 years that you drive the car, you will be producing a certain amount of emissions. Those emissions are associated to the company that sold you the car as scope 3. So, and you as a driver, because of a higher carbon taxes, you are going to be faced with higher levies and fees for the emissions you produce. So overall, the total cost of owning the car, the true cost of owning a car, increases. You might not see it in the retail price, but over time, because of transition, it'll be more costly to drive a diesel car. So essentially what we did is we computed based on scenarios on carbon tax, we computed how much this true cost of owning a car would increase. And then we used a simple approach to model the impact on sales. So we thought that, okay, this increase in true cost is more or less an indirect tax. Think of it as a VAT. So essentially what we did is we simulated a beta for VAT changes on sales of companies, and went with that beta and produced an estimate on how sales and revenues will drop by increases in carbon prices.
Thank you.
And can you remind me your first question
again?
And
the first question was about the static versus dynamic balance sheets of the bank. So considering how banks might change their balance sheets through time.
Definitely. So this is a very relevant question because over 30 years, over such long horizons, obviously one will assume that banks will adjust. And we know that banks can be actually quite agile in cases and quickly rebalance their portfolios. However, for the sake of simplicity here, we follow the static balance sheet, which is something that everybody does. However, in the future, we are considering a dynamic extension. There are models in the ECB that are able to compute dynamic balance sheet response by banks. So essentially what we're thinking is having a framework where banks will be able to choose between investing in green loans and divesting brown loans and see how that mix will change. It's not very clear yet how we will do it, but the idea is there. We have the capabilities to achieve those results. And the next step, of course, will be to see how that will affect the real economy. Meaning, if reduction of loans to brown companies takes place, how will that affect GDP? Second round effects. And definitely it's something that we're thinking about.
Thank you very much.
Any other question from the audience?
I saw a question in the chat that asks, what does it mean where PDs are negative?
Yes.
So I'll just go quickly to that slide. Now, PDs are not negative. So essentially what this slide is showing is the difference between PDs in the two adverse scenarios versus orderly transition. So when these PDs are negative, it means that for that firm, the probability of default in the orderly transition scenario is higher than the probability of default in the other two. So essentially, and we've labeled it this way, is that there are short-term costs of the orderly transition in the beginning, particularly because the PDs under the orderly transition are higher. I hope that makes it more clear.
Okay. Any other question? One question. Can you comment on diff between this top-down exercise and the one going on right now, restricted bottom-up?
I'll give you my comments and understanding of the two exercises. However, I did not work for ECB banking supervision, and I was not responsible for that exercise, so I wouldn't be able to share too much insights. However, the difference is that the SSM will ask, or has already asked, banks to give them results on several sets of portfolios and metrics for a variety of scenarios that they've shared with them. So this is a top-down exercise, meaning that we developed data and we collected data and developed models ourselves, and we run corporate loan book repricing. Whereas in the top-down exercise, banks will run the repricing themselves, and we give them to the supervisors to assess the results. The commonality between the two exercises is that they're both of a learning nature. So ours was more to propose a general framework of running a climate stress test, of repricing loans for climate change, and essentially putting it out there and helping those in the financial sector, investors or banks, to better mitigate, understand, and manage these risks. Whereas for the supervisors is more to understand how ready and how advanced banks are at handling climate risk through their risk management frameworks. So there won't be any capital charges through this stress test, also relating to the question that was heard before. But it's more for the supervisors to understand if banks can already assess in a satisfactory manner those climate risks.
Okay, thank you very much. More questions? Well, I guess we'll stop here. Obviously, I would like to thank Hyeyoon and Spyros for accepting to present their paper. Very interesting paper on a very important topic. I think this was enlightening for everyone. Thank you for all the participants. We had a good turnout today. It's really interesting to see that so many people are interested in this topic. Our next webinar will be in April. We haven't defined yet the exact topic, but it's going to be around climate change again, but from a different angle. We'll keep you posted. We'll send you the information very quickly. Once again, thanks Hyeyoon and Spyros for a very good presentation, very interesting presentation, and we look forward to seeing you very soon. Thank you very much, and take good care.
Thank you for having us.
Thank you very much.
Thank you.
Thank you.